Hello everyone. By now, you understand what stocks are, how the stock market works, how people make money with stocks, the risks involved, and how investors think about risk versus reward. At this stage, many beginner investors reach a moment of confusion. They look at a stock chart and ask a simple but critical question: why do stock prices go up and down at all? If a company hasn't changed overnight, why does its stock price change every day? Why can prices rise even when news is bad, or fall when news seems good? And how can millions of people disagree on what a stock is worth at the same time? Understanding why stock prices move is essential. Without this understanding, price changes feel random and emotional. With it, market behavior starts to make sense, even when it feels uncomfortable. This video explains why stock prices fluctuate, what actually drives those movements, and how investors should think about price changes without reacting emotionally. So what does a stock price actually represent? To understand why stock prices move, we must first understand what a stock price represents. A stock's price is not a precise measurement of a company's true value. It is the most recent price at which buyers and sellers agreed to trade. In other words, a stock price is a snapshot, a moment in time, and a reflection of supply and demand. It represents what someone was willing to pay and what someone else was willing to accept, right now. This means stock prices are opinions expressed through transactions, not objective facts. So why are stock prices determined by buyers and sellers? Stock prices move because markets are made of people, and people disagree. Every trade requires a buyer who believes the stock is undervalued, and a seller who believes the stock is fairly valued or overvalued. When more buyers than sellers exist, competition pushes prices higher. When more sellers than buyers exist, prices decrease. There is no central authority setting stock prices. Prices emerge from collective behavior, which is why they constantly change. This is the core engine behind all price movement. So why do expectations matter more than current results? A common beginner misunderstanding is believing stock prices move based solely on what a company did in the past. In reality, stock prices are forward-looking. Investors care less about what a company earned last year, and more about what it is expected to earn in the future. When expectations change, prices move, even if nothing has happened yet. If investors believe future profits will increase, prices tend to rise. If they believe future profits are at risk, prices tend to fall. Stock prices move on changes in expectations, not just on events themselves. So why do stock prices react to news? News affects stock prices because it changes expectations. News can include earnings reports, economic data, interest rate decisions, product announcements, regulatory changes, and global events. Importantly, it's not whether news is good or bad in isolation, it's whether it's better or worse than expected. If good news was already anticipated, prices may not rise. If bad news was feared but turns out less severe, prices may rise. This explains why stock prices sometimes move in ways that seem counterintuitive. So why do emotions cause stock prices to fluctuate? Markets are driven by logic, but also by emotion. Fear and greed are powerful forces. Fear causes investors to sell quickly, and greed causes investors to chase rising prices. During periods of uncertainty, fear can dominate, pushing prices down faster than fundamentals justify. During optimistic periods, greed can push prices higher than reality supports. These emotional cycles are normal and recurring. Understanding them helps investors avoid reacting emotionally themselves. So why does supply and demand change so often? Supply and demand for stocks changes constantly because investors' circumstances change. Reasons may include portfolio rebalancing, changes in interest rates, shifts in economic outlook, and personal financial needs. Large investors, such as pension funds and institutions, move enormous amounts of capital. Their actions alone can influence prices, even without any change in company fundamentals. Price movement does not require universal agreement, only imbalance. So why do stock prices change even when companies don't? This is one of the most confusing aspects for beginners. A company can operate normally while its stock price fluctuates daily. This happens because stock prices reflect expectations, markets constantly reassess future outcomes, and because external factors influence investor decisions. Economic conditions, interest rates, and global events can affect prices without affecting a company's immediate operations. This is why price volatility does not always signal business weakness. So why do interest rates affect stock prices? Interest rates influence stock prices because they affect borrowing costs, consumer spending, business investment, and alternative investment returns. When interest rates rise, borrowing becomes more expensive, future profits may be discounted more heavily, and stocks may become less attractive relative to bonds. When interest rates fall, borrowing is cheaper, growth becomes more attractive, and stocks may rise in value. Interest rates act as a gravitational force on asset prices. So why do stocks move differently at the same time? Not all stocks move together. Different companies respond differently to economic cycles, consumer behavior, technological change, regulation, and competition. This is why diversification works. Price movement is not uniform across the market. Understanding that stocks behave differently helps investors avoid overgeneralizing market movements. So why does volatility increase during uncertainty? Volatility increases when uncertainty rises. Uncertainty widens the range of possible outcomes. When investors disagree more strongly about the future, prices swing more aggressively as opinions shift. Events that increase uncertainty include recessions, political instability, financial crises, and unexpected economic shocks. Volatility reflects disagreement, not chaos. So why is short-term price movement hard to predict? Short-term price movement is difficult to predict because new information emerges constantly, investor reactions are unpredictable, emotional responses vary, and because large investors influence prices. This is why long-term investing relies less on prediction and more on discipline. Markets are efficient in aggregating information, but inefficient in emotional consistency. So how should investors interpret price movements? Price movement should be interpreted in context. Questions investors ask include: has the company's long-term outlook changed? Is this movement driven by emotion or fundamentals? And does this affect my strategy or time horizon? Not every price movement requires action. Understanding why prices move allows investors to respond thoughtfully, or not at all. So why is price movement not the same as risk? Price volatility is often mistaken for risk. Risk involves the probability of permanent loss. Volatility reflects temporary disagreement. For long-term investors, volatility is a feature of markets, not a flaw. Confusing the two leads to unnecessary emotional decisions. So how do long-term investors view price fluctuations? Long-term investors expect prices to fluctuate. They understand that markets move in cycles, prices overshoot in both directions, and that short-term noise does not determine long-term outcomes. Rather than fearing volatility, long-term investors plan for it. Stock prices go up and down because markets are living systems made of people, expectations, information, and emotion. Prices reflect supply and demand, changing expectations, new information, economic conditions, and human behavior. Understanding this transforms price movement from something confusing into something explainable. When investors understand why prices move, they stop reacting emotionally and start thinking strategically. That understanding is what allows long-term investing to work. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.